So if you've ever spent any time in a hospital ICU, you probably know that sound. You know, that steady, rhythmic beep of a patient monitor.
Oh, yeah. It just kind of blends into the background after a while.
Exactly. As long as the rhythm is consistent, it's just background noise. But the second that line spikes, or, it dips, or the frequency changes even a little bit.
Everyone in the room is instantly paying attention.
Yeah, exactly. Every clinician stops looking at the broader environment and they look strictly at the data on that screen. Because you have to try to piece together the underlying story of what's actually happening with the patient's physiology.
That is honestly the perfect framing for what we do here, because the headline numbers we get on an earnings drop, they're really just the vital signs, right?
Right.
They tell you if the corporate patient is, alive and cooking, but they tell you absolutely nothing about the underlying vascular health or the metabolic rate or why the heart rate just spiked.
Yeah, to figure out if a stock is actually worth holding for you, the retail investor, you really have to run a full diagnostic on the mechanics behind those numbers.
Exactly.
And that is our mission for this deep dive today. We are looking at a massive, highly diversified medical technology giant, and we're going to run that full diagnostic. We're looking at the Q2 2026 earnings report from Becton Dickinson, ticker symbol BDX.
Yeah, and we've got a lot to unpack with this one.
We really do. So we'll have to start by setting the table with the raw data we have in front of us. Top line revenue came in at $4.7 billion. So that represents a 2.6% year-over-year growth rate.
Which is pretty solid.
Yeah, it is. And then moving down the income statement, adjusted earnings per share, or EPS, landed at $2.90, which is a 3.9% increase. And on the institutional side, the immediate market reaction was that both of these metrics essentially beat Wall Street's expectations.
They did. But, whenever you hear adjusted, you have to look closer.
Right, because looking at the actual transcript, there's this massive $450 million non-cash asset impairment charge. And that just got entirely adjusted out of the EPS number.
Yeah, it did.
And look, we know management teams always love to scrub their earnings of these quote unquote one-time events. But $500 million, that is a massive write-down to just wave away.
It is a huge number. I'm not downplaying that.
Yeah.
But you really have to look at the structural mechanics of where that specific charge actually came from.
Okay, walk us through it.
It's directly tied to the separation of their life sciences business. They recently spun that off and combined it into a joint venture with Waters. And when a massive med tech conglomerate like BDX carves out an entire division like that, you are essentially untangling two nervous systems that have grown together over, decades.
Right, because they share everything.
Exactly. You have shared IT infrastructure, shared manufacturing footprints, shared real estate. So that impairment charge, it really just represents the write-down of legacy assets and stranded costs that they no longer have a place in the new operational structure, the new BD, as they call it.
Okay, so it's basically an accounting reality.
Yeah, it's a paper loss recognized under GAAP accounting, but it has absolutely zero impact on the actual cash generation or the operating efficiency of their core medical device business today.
Okay, that tracks. The core business generated 3.9% more profit per share than it did in the same quarter last year, once you do strip out all that restructuring noise.
Yeah.
But I am looking at the margin profile here, and this is where, for me, the bullish narrative starts to look a little shaky. Let me give you the numbers. The adjusted gross margin came in at 54.7%, which is down 90 basis points from the prior year. Yep. And then adjusted operating margin was 24.2%, which is down 110 basis points. So, if the margin on every single dollar of revenue is shrinking, the underlying business is losing its operating leverage. Why are analysts calling this a beat when the core profitability engine is visibly cooling down?
Well, because you are looking at the net result without isolating the external variables. Shrinking margins are absolutely a massive red flag if they're caused by, say, pricing pressure.
Like if hospitals are just refusing to pay a top dollar for the product.
Exactly. Or if they are caused by internal corporate bloat. But neither of those things actually happened here. The entirety of that margin compression and then some was driven by a single macroeconomic variable.
Which was?
Tariffs. BDX absorbed a brutal 160 basis point structural headwind strictly from international tariffs.
Wait, let me stop you right there because we really need to properly size that for everyone listening. A 160 basis point drag on gross margin for a company doing nearly $20 billion a year in total revenue, That is an astronomical penalty.
Oh, it's a massive anchor tied around their neck.
I mean, it means before they even turn on the lights in the factory, before they pay a single engineer, their cost of goods sold is artificially inflated by 1.6%.
It is. But look at the math here. The tariff headwind was 160 basis points, right? But the actual reported gross margin only declined by 90 basis points.
Oh, wow. Okay. So that means there is a positive 70 basis point delta in there somewhere.
Exactly. They didn't just passively absorb it. They structurally outoperated the macroeconomic drag. They managed to generate 70 basis points of pure internal productivity gains and favorable product mix.
So they basically clawed it back internally.
Yeah. Think about it. If those geopolitical tariffs had magically vanished on the first day of the quarter, BDX would have actually reported massive margin expansion.
Right.
The internal engine isn't cooling down at all. It is actually running so hot and so efficiently that it nearly absorbed a massive, totally unexpected tax on their supply chain. And that is exactly why the institutional side read this as a beat.
Because the management team essentially proved they can out-execute external macroeconomic shocks. Okay, I see that. The productivity offset is impressive, but you can't just conjure 70 basis points out of thin air.
No, you definitely cannot.
That requires either ruthless cost cutting on the factory floor, or it requires a massive shift in what you are actually selling. So let's look at the product mix, the story behind these numbers, because CEO Tom Polen highlighted that over 90% of their entire global portfolio grew at roughly 5%.
Which is a very solid, predictable baseline for a company this size.
It is. But the real margin expansion, the stuff that moves the needle, comes from the high growth outliers within that 90%. And I want to look specifically at advanced patient monitoring, or APM. They posted 12% growth here.
Yeah, that was a huge standout.
It was driven by the Hemisphere platform and these new Alta and Stream modules. What exactly is the technological leap here that justifies double-digit hospital adoption?
The technological leap is, frankly, the eradication of the invasive arterial line for continuous monitoring.
Okay, unpack that for us.
Historically, if a clinician needed real-time continuous blood pressure data, meaning they need to see the actual waveform of every single heartbeat on the screen, they had to insert a catheter directly into the patient's artery.
Wait, like physically into the artery?
Yes. It's a highly invasive procedure. It carries significant infection risks. It's painful, requires specialized nursing skills to maintain. And because of all that, you really only see it in the intensive care unit or the operating room.
So you can't just have that on a normal hospital floor?
Right. But the Stream module completely changes the paradigm. It allows for continuous ICU-grade blood pressure monitoring, but non-invasively.
So they're essentially moving high acuity data collection out of the ICU and onto the general med-surg floors?
That is the commercial genius of it right there. By making the technology non-invasive, you instantly expand your total addressable market. You no longer need a $3,000 a night ICU bed or a highly specialized intensivist doctor just to justify the monitoring. A standard floor nurse can set it up in minutes.
And hospitals are aggressively adopting this because I assume it solves a massive economic problem for them.
Two massive problems, actually. First, it improves patient safety by catching deterioration much earlier on lower acuity floors. And second, it totally optimizes bed management. You don't have to keep a patient taking up an expensive ICU bed just because they need continuous monitoring. The 12% growth in APM is a direct reflection of hospitals doing that underlying economic math.
I see the margin implications there perfectly. You sell a highly differentiated proprietary piece of hardware that fundamentally changes hospital economics. You get to dictate the pricing.
Exactly. You have total pricing power.
Let's pivot to another double-digit growth engine that falls into that exact same category of changing the standard of care, PureWick. This is sitting in their urology and critical care division. For those not familiar, PureWick is a female external catheter.
Which is arguably one of the most important shifts in basic hospital care in the last decade.
Right, because it's essentially replacing the traditional indwelling Foley catheter.
Yeah, and indwelling catheters are notorious for causing catheter-associated urinary tract infections. We call them CIUTIs in the industry.
And CIUTs aren't just bad for the patient clinically, they are financially toxic for the hospital.
Completely toxic.
Because Medicare flat out refuses to reimburse hospitals for treating infections that the patient acquired while admitted. If a hospital gives a patient a UTI via a traditional catheter, the hospital eats the entire cost of the extended stay, the antibiotics, everything.
It costs the healthcare system billions of dollars annually. It's a huge burden.
So PureWick solves that.
Yes, PureWick eliminates that internal infection vector entirely because it just sits externally. The adoption rate inside the acute care setting, inside the actual hospitals, has been phenomenal. But what drove the outsized double-digit growth this specific quarter wasn't just traditional hospital sales.
What was it?
It's their aggressive expansion into the home care market and the Department of Veterans Affairs.
Oh, right. The transcript notes they made a highly targeted $35 million investment at the start of the year specifically to build out the sales force for those alternative channels.
It's a textbook example of identifying a secondary total addressable market and aggressively resourcing it.
Yeah.
I mean, the VA manages a massive aging veteran population with very high rates of incontinence.
Makes sense.
Furthermore, the broader healthcare system right now is desperately trying to shift patient care out of expensive acute care facilities and into the home. By providing the PureWick at home system, VDX is catching a massive demographic tailwind. And the recurring revenue from the disposable wicks creates this highly predictable, high-margin annuity stream.
Because you constantly have to buy new wicks.
Exactly. It's the razor and blade model, but for healthcare.
That recurring consumable revenue really is the holy grail in medtech. But if we are talking about massive tailwinds, we absolutely have to talk about the 800-pound gorilla in the healthcare sector right now, which is biologics and GLP-1 weight loss drugs.
Oh, absolutely. It's the biggest story in pharma.
Yeah. BDX's biopharma systems segment is seeing huge double-digit growth here. And to be clear, they aren't formulating the drugs themselves.
Right. They aren't Novo Nordisk or Eli Lilly.
They aren't making Ozempic, but they are manufacturing the physical delivery systems for it.
They are providing the picks and shovels for the gold rush. And it is really vital for you to understand the mechanics of biologics, to understand why BDX has such a strong economic moat here. Biologics are large molecule therapies.
Meaning they're physically larger at a chemical level.
Exactly. Because the molecules are so large and complex, they generally cannot be synthesized into a pill form. If you swallow a biologic drug, your stomach acid destroys the complex protein structures way before they can ever enter your bloodstream.
So you have to bypass the stomach.
Right. Therefore, almost all biologics must be injected.
And these aren't your standard, water-thin flu vaccines. I've looked at the viscosity profiles of some of these newer biologics, and they are incredibly thick. You can't just draw them up in a cheap generic plastic syringe with a standard needle gauge.
No, you really can't. The fluid dynamics are entirely different. Delivering a highly viscous biologic drug requires specialized, engineered hardware.
What kind of hardware?
Well, you need specific glide forces inside the syringe barrel. You need ultra-thin wall needles that won't clog, but also won't cause excessive pain to the patient. And increasingly, you need highly sophisticated auto-injectors. The pharmaceutical companies actually rely heavily on BDX to engineer these delivery systems alongside the drug development process.
Oh, so they co-develop it.
Yes. And on the call, management announced they secured 2 significant long-term customer wins for next-generation GLP-1 programs with leading global pharma companies.
The scale of that transition inside their business is just wild to me. They noted that biologics as a whole now represent roughly 55% of their total biopharma systems segment revenue, and that's up from 50% just recently.
Right, it's shifting fast.
It implies the legacy small molecule and standard vaccine delivery business is being rapidly dwarfed by these highly engineered, high-margin biologic delivery systems.
And it fundamentally changes the margin profile of the whole segment. I mean, the average selling price, the ASP, of a complex spring-loaded auto-injector is exponentially higher than a standard piece of plastic, like a pre-filled syringe.
And capping off the high-growth stars in the quarter, they also saw double-digit growth in advanced tissue regeneration.
Yeah, this is primarily synthetic hernia products and cosmetic tissue reconstruction, mostly over in Europe and Brazil right now.
The mechanics here are fascinating to me because we are seeing a shift away from older permanent meshes, which, had really high complication and rejection rates, toward these advanced biomaterials that actually integrate better with the patient's own tissue.
It's a huge step forward clinically.
And when you combine that with the massive global catch-up in elective surgeries post-COVID, you just have a perfect storm for volume growth.
So when you aggregate all of that APM, PureWick, biologics, and tissue regeneration, you can see exactly where that 70 basis points of margin offset came from.
Because the fastest growing parts of the portfolio also happen to be the most technologically advanced and the highest margin.
Exactly. The mix is pulling the entire ship upward.
Right. But look, we can't just ignore the anchors. The remaining 10% of the portfolio is facing brutal headwinds, and we need to unpack them for the investors listening.
We do. It wasn't all perfect.
First on the list of headwinds, Alaris infusion pumps. Now, the transcript shows they are actually gaining market share up 50 basis points in the quarter, 150 basis points year to date.
Yeah.
Yet, Alaris is dragging down the total company growth rate by 200 basis points. That sounds like a complete mathematical contradiction. How on earth do you gain market share but drag down overall growth?
I know, it sounds crazy, but it's purely a function of a totally distorted year-over-year baseline. The context here requires a quick look at the regulatory history of the product.
Okay, remind us what happened.
A few years ago, BDX faced a massive FDA hurdle with the Alaris system. They essentially had to pull it from the market to completely overhaul the software architecture and the hardware integration.
Wait, so for 3 whole years, hospitals just couldn't buy new ones?
Exactly. They were completely frozen out. Hospitals were just limping along with their aging fleets, repairing broken units as best they could.
And in the medical device world, a capital equipment fleet like an infusion pump usually operates on a highly predictable 5 to 7 year replacement cycle.
Right.
So if you freeze that replacement cycle for 3 whole years, you build up a massive dam of deferred demand.
And last year, that dam broke. The FDA finally cleared the updated Alaris system, and every single hospital system that had been waiting 3 years instantly submitted massive capital orders all at once to upgrade their fleet.
So the revenue just exploded.
The revenue spiked to astronomical, completely unsustainable levels last year.
Yeah.
What we are seeing this quarter is just normalized run rate demand being compared to a historic one-time super cycle.
Honestly, I'm looking at the competitive landscape, and it's remarkable to me that hospitals actually waited 3 years for Alaris instead of just switching to a competitor. Like, why not just buy from Baxter or ICU Medical?
It speaks to the extreme stickiness of the product.
Because an infusion pump isn't just a standalone device anymore, right?
Exactly. It's deeply, deeply integrated into the hospital's electronic health record system, like Epic or Cerner. It communicates directly with the pharmacy servers, the cybersecurity architecture. Ripping out an entire fleet and retraining thousands of nurses on a completely new user interface is a logistical nightmare for a hospital.
The switching costs are just astronomically high.
They are. And that is exactly why management noted they didn't lose a single infusion account during that entire 3-year remediation period. Not one. The market share is growing, the installed base is expanding, and the recurring revenue from the dedicated IV tubing sets, which, by the way, grew low double digits this quarter now that the global IV fluid shortage has resolved, is highly profitable.
So the 200 basis point growth headwind is basically an accounting illusion.
Yes, it is not a reflection of commercial weakness at all.
Okay. Now, the other 2 headwinds are a bit more straightforward, but equally impactful. Lower global vaccine demand and market dynamics in China.
Yeah, the vaccine hangover is just an industry-wide reality. The pandemic-era demand for billions of specialized COVID-19 vaccine syringes has evaporated, obviously, leaving a massive gap in year-over-year comparisons.
But China is a structural issue, right? We were talking about value-based procurement, or VBP.
Yes, VBP. For the retail investor, VBP is essentially the Chinese government leveraging its monopoly purchasing power. They basically mandate brutal price cuts on medical devices in exchange for massive volume contracts across their entire state-run hospital system.
It severely compresses gross margins. You win the volume, but you sacrifice all the pricing power.
Exactly. However, BDX management has been very, very strategic about isolating this exposure. China currently represents only about 4% of the new BD total revenue.
No, that's fairly small.
It is. And because the rest of the high-margin portfolio is growing so rapidly, they actually expect the China exposure to naturally dilute down into the 3% range soon. It's a localized drag, sure, but it doesn't threaten the global operating leverage.
Okay, so we've dissected the products, the mix, the tariffs, the headwinds. But frankly, every medtech company has a mix of high-growth stars and legacy anchors. What separates the truly great operators from the mediocre ones is how they actually manufacture those products.
Operations is where the money is made.
Exactly. We've talked around it, but we need to dive deep into BD excellence. CEO Tom Poland emphasized this continuously on the call. He stated that 3.5 years ago, this internal operating system literally didn't even exist. Today, they are running over 2,000 Kaizens across the organization, and that drove the 8% productivity gain in the quarter.
The implementation of a true lean manufacturing culture is arguably the most important long-term value driver in this entire earnings report.
For those who don't know, what is a Kaizen?
A Kaizen, which is rooted in Japanese manufacturing philosophy, is a structured event focused on continuous incremental improvement. It basically involves taking the engineers, the line workers, and the supply chain managers, putting them directly on the factory floor, and ruthlessly analyzing every single movement.
Like optimizing every millimeter.
Yes, every millimeter of material waste, every second of machine downtime.
And in a company that manufactures billions of consumable plastic components a year, I imagine saving a fraction of a cent or a fraction of a second on a production line compounds massively.
It compounds into tens of millions of dollars in free cash flow. But here's the thing. They aren't just tweaking the existing lines. They are fundamentally restructuring the entire physical footprint.
Right. Management stated they're building a simpler, more efficient manufacturing network. They have reduced their global footprint by roughly half, taking it down to around 50 sites. But when I read cutting factory footprint in half, my initial reaction as an investor is that the company is shrinking its capacity because demand is falling.
I get that, but it is the exact opposite. They are not shrinking capacity. They are consolidating it. Think of it like a major tech company modernizing its IT infrastructure. Years ago, a company might have had 100 small, inefficient server closets scattered across different regional offices. They were expensive to maintain, they had overlapping redundancies, and they lacked the scale to run advanced software.
Right, a total mess.
But by closing those 100 local closets and consolidating everything into 50 massive, hyper-efficient cloud data centers, you vastly increase your total computing power while drastically lowering your maintenance costs.
Oh, that is a perfect analogy, because you can't justify installing cutting-edge robotics, predictive maintenance sensors, and AI-driven quality control systems in a small legacy factory making one specific product.
Exactly. The ROI isn't there.
But if you consolidate 5 small factories into one massive scaled super facility, the return on investment for automation goes through the roof.
And that scale creates a massive operational flywheel. By concentrating their capital expenditures into these 50 super sites, they've achieved record safety levels, and their customer service orders fulfillment rates are now sitting consistently above 90%.
Which means the commercial sales reps are actually spending their time selling new, high-margin products like Hemisphere and PureWick, instead of spending half their week apologizing to hospital procurement officers for back-ordered syringes.
Precisely. And the BD Excellence methodology is now actually bleeding out of the factories and into the R&D labs. Management highlighted that by applying these exact same lean principles to 5 new product development programs, they successfully reduced the average time to launch by 10 months.
Wait, let's contextualize what saving 10 months means in the medical device industry. R&D is a grueling process of prototyping, clinical validation, and navigating FDA submissions.
It takes years.
Shaving almost a year off that timeline is staggering. It means 10 additional months of patent exclusivity, 10 additional months of generating high-margin revenue before competitors can react, and most importantly, it gets life-saving technology into the hands of clinicians nearly a year faster. That is pure, unadulterated operating leverage.
It really is the hallmark of a world-class manufacturing operation.
Okay, but I'm going to challenge that world-class label right now.
Oh. Because if you are running a flawless lean manufacturing network, you don't get slapped with FDA warning letters.
Fair point. And
just last Thursday, BDX received a formal warning letter regarding their El Paso, Texas facility. This plant manufactures ChloraPrep and PurePrep, which are absolutely critical surgical infection prevention products. In response to the FDA, BDX voluntarily placed these products on a ship hold in the U.S. market.
They did.
A ship hold means finished goods are just sitting in a warehouse, unable to be monetized. As an investor, reading the words warning letter and ship hold triggers an immediate sell reflex. Why shouldn't we view this as a systemic breakdown of their quality control?
Because you really have to read the actual regulatory mechanics behind the headline, not just the scary keywords. The CEO addressed this head-on during the call, and the context completely defangs the perceived risk.
Okay, defang it for me. First and foremost, this is not a product recall. The millions of units of ChloraPrep already sitting on hospital shelves and being used in operating rooms right now are perfectly fine. Management explicitly stated there have been absolutely 0 patient safety signals, and they stand completely behind the clinical efficacy of the product.
Okay, so if the product is safe and there are no clinical issues, what exactly triggered the warning letter and the subsequent ship hold?
It comes down to a highly specific discrepancy in final release testing protocols. BDX manufactures this product for global distribution. For years, they've utilized a specific rigorous testing loop for the units destined for the European market to satisfy the CE mark requirements over there.
Okay.
The FDA determined that BDX needs to apply that exact same European testing standard to the units destined for the US market.
Wait, so the FDA is just asking them to use the tests they already have built and are actively using for their international shipments?
Precisely. BDX doesn't have to invent a new test. They don't have to redesign the product. They just have to route the US-bound inventory through the existing European testing protocol. The ship hold is simply the procedural delay required to run that test on the finished goods before they leave the facility. The testing loop takes about 3 weeks to complete.
I hear the explanation and it sounds benign, but I am going to push back hard on the financial implications of this. Even if it's just a 3-week testing loop, a 21-day delay introduces a massive bottleneck into a finely tuned, lean supply chain. The factory lines in El Paso are still running at full speed, right? They haven't halted production.
That's correct. Manufacturing is operating normally.
So if they are pumping out millions of units a week, but they can't ship them for 21 days, they are building a massive mountain of finished goods inventory in the warehouse. In the financial modeling world, that is trapped working capital.
It is.
They are paying for the raw materials, they are paying the labor, but they aren't generating the cash from the sale. Doesn't introducing a 21-day inventory backlog directly hit their free cash flow for the quarter?
It's an excellent point regarding working capital dynamics, but again, you have to look at the scale of the product within the broader portfolio. ChloraPrep is an important product, yes, but it is one specific line item inside a $19 billion global engine.
So you're saying it's a drop in the bucket?
The working capital tied up in a rolling 3-week quarantine of one product line is literally a rounding error on their balance sheet. Furthermore, hospitals maintain their own safety stock of these critical supplies.
Right, they don't buy them daily.
Exactly. A 21-day delay in replenishment shipments is highly unlikely to cause stockouts at the end user level, which means BDX isn't permanently losing those sales to competitors. The revenue is simply deferred by 3 weeks. Once the initial batch clears the 21-day test, it becomes a continuous rolling release. The financial impact of the quarter is negligible, and it certainly doesn't indicate a systemic failure of BD excellence.
Fair enough. You've convinced me it's a procedural speed bump, not a structural crack in the foundation. So we've navigated the headline numbers. We understand the 70 basis point margin offset, the double-digit growth drivers, the Alaris and China headwinds, and the reality of the FDA situation.
We covered a lot of ground.
We did, but the market doesn't pay for the past. It pays for the future. We need to look at management's forward guidance. Management reaffirmed their full-year revenue guidance of low single digits. They are expecting the macro environment and the Alaris comps to keep top-line growth relatively flat.
Yeah.
However, they simultaneously raised their full-year adjusted EPS guidance to a range of $12.52 to $12.72, and they expect adjusted operating margins to hold steady at roughly 25%. Walk us through the financial physics of this. How do you raise your profit outlook when you explicitly acknowledge your sales growth is stalling?
You do it through profit and loss leverage, or P&L leverage. It is the ultimate metric of a management team's competence, in my opinion. In a standard, unoptimized business, revenue and profit move in a linear lockstep. If you want a 5% increase in earnings, you have to find a way to sell 5% more volume.
Right. It's a 1-to-1 ratio.
But BDX has broken that linear relationship. They are proving they can extract significantly more bottom-line profit out of the exact same top-line dollar.
And the mechanism driving that extraction is the cost-out program, right?
Yeah.
They set a target to remove $200 million of structural costs from the business.
Correct. And on the call, they confirmed they have already achieved a $150 million run rate on that program. They have clear line of sight to capture the remaining $50 million by the end of next year. They are basically squeezing the waste out of the system, capturing the efficiencies of those 50 consolidated factories, and realizing the benefits of the 10-month reduction in R&D cycles.
So the operational engine is so highly tuned that the bottom line EPS can literally outrun the top line revenue headwinds. The internal mechanics are sound, but management doesn't operate in a vacuum. Let's talk about macroeconomic exposure, specifically inflation and commodity prices.
The big fears right now.
Yeah. BDX manufactures billions of plastic components, syringes, catheters, IV tubing, vial adapters. The fundamental building block of medical-grade plastic is petroleum resin. Given the geopolitical instability and the massive fluctuations in the oil markets, If crude oil spikes to $100 or $120 a barrel, doesn't that immediately blow up their cost of goods sold and destroy the 25% operating margin they just guided to?
It was actually a central point of debate during the Q&A portion of the call. Several analysts, including Travis Steed and Matt Miksic, pressed management hard on their resin exposure. But the data they provided completely neutralizes the panic.
What data?
First, management explicitly sized the exposure. Resins and molded plastic components represent only about 5% of their total cost of goods sold.
Wait, genuinely? Just 5%. Given the sheer volume of plastic they push through the global healthcare system, I would have modeled that exposure at like 15% or 20%.
A lot of people do. But the value of their products is increasingly in the advanced engineering, the proprietary IP, and the embedded software, not the raw plastic barrel.
Wow, okay.
But even on that 5% exposure, they are not just buying off the spot market and subjecting themselves to daily commodity swings. They operate a highly sophisticated hedging program. In North America, which is their largest market, 50% of their resin supply is completely hedged.
Let's detail the mechanics of that hedge for the retail investor. They are essentially writing forward contracts to lock in a predetermined price for the physical delivery of the resin over the next 6 to 12 months.
Right.
So if geopolitical tensions cause oil to spike tomorrow, BDX is insulated because their suppliers are contractually obligated to deliver the resin at the previously negotiated lower price. It acts as an insurance policy against margin compression.
Exactly. It provides immense visibility and stability to their COGS in the current fiscal year. But, as the analyst rightly asked, what about the long-term impact? Eventually, hedges roll off. If oil stays structurally elevated into 2027, BDX will have to write new contracts at the higher spot prices.
Right. A hedge just buys you time. It doesn't change reality forever. So how is management actually modeling for that eventual rollover?
With extreme conservatism. The CEO explicitly stated they're not relying on hope. They are not modeling a scenario where oil miraculously drops back down. They are building their 2027 financial plans under the strict assumption that resin costs remain at these elevated levels.
Smart.
Because they have a 5 to 6 month visibility window on how those raw material costs flow through their inventory and eventually hit the P&L, a dynamic they refer to as cap and roll. They have half a year to formulate a counter strategy.
And what is the primary weapon in that counter strategy? It has to be pricing power.
It is entirely pricing power. Because they provide mission-critical, highly differentiated clinical hardware like the Hemisphere monitors, the Puix's automated pharmacy cabinets, and the PureWick Systems hospitals cannot easily substitute them for cheaper, generic alternatives.
They just have to pay the higher price.
Yeah, management is actively prepping targeted pricing actions to pass a portion of those anticipated resin costs along to the market. Between the hedging buying them time, the continuous BD excellence cost-cutting absorbing the blow, and the pricing actions offsetting the rest, they've effectively neutralized the oil threat to their 2027 margin profile.
That level of tactical financial defense requires serious talent at the CFO desk. Which brings us to a major structural announcement from the call. Tom Polen confirmed that Vitor Roque, who stepped in as interim CFO late last year, has officially been named the permanent chief financial officer.
And the context of that appointment tells you everything you need to know about the board's confidence in the current trajectory. They didn't just hand him the job. They ran a comprehensive search with a top-tier executive firm, evaluating external candidates. But they ultimately chose Vitor, a 25-year veteran of BDX.
Which makes sense. When you are successfully executing a massive internal restructuring, consolidating 100 plants down to 50, spinning off life sciences, optimizing working capital, the absolute last thing you want is a wildcard external CFO coming in and trying to reinvent the wheel just to make their mark. You want institutional knowledge.
Completely agree. When an analyst asked Vitor what his primary focus would be, he didn't pitch a radical new vision. He emphasized continuity. He literally said, it's not about changing drastically, but it's sharpening the execution and not changing direction.
He emphasized a relentless focus on capital discipline, optimizing cash conversion cycles, and returning value to the shareholders.
This is exactly what you want to hear.
Which provides the perfect logical bridge to our final diagnostic, the bottom line. We've looked at the income statement, the operations, the headwinds, and the forward models. Now it's time to look at the balance sheet and the actual cash. Because earnings per share can be massaged with accounting adjustments, as we saw with the $450 million charge. But free cash flow is an undeniable physical reality. What did BDX generate?
They generated a staggering $1.1 billion in free cash flow year to date. That represents a significant increase from the same period last year.
And given that revenue only grew 2.6%, that massive surge in cash flow couldn't have come purely from new sales. Where did Vitor Roque find the extra cash?
By heavily optimizing working capital. He highlighted improvements in collections, meaning they are shrinking their day sales outstanding and forcing hospitals to pay their invoices faster.
Always a good move.
He also highlighted massive improvements in inventory management. By utilizing the BD Excellence Lean principles, they are holding less safety stock and turning their inventory over faster. They are no longer letting hundreds of millions of dollars sit trapped in warehouses. They're converting it directly into liquid cash.
That liquidity gives them immense strategic optionality. Let's look at the debt profile. They retired $2.1 billion of debt during the quarter. They ended the period with a net leverage ratio of approximately 2.9 times.
Which is an incredibly healthy ratio for a company with such highly predictable, defensive, recurring revenue streams. But Vitor Roque stated they remain committed to driving that leverage down even further to their long-term target of 2.5 times. It showcases a hyper-conservative approach to the balance sheet in an unpredictable interest rate environment.
Okay, so they have $1.1 billion in free cash flowing in. The debt is manageable and trending down. How are they deploying the excess capital? A management team's capital allocation strategy is the ultimate lie detector test. They can say whatever they want on a conference call, but where they actually write the checks reveals what they truly believe.
Management was remarkably transparent about their capital prioritization. Number one, share repurchases. Number two, the dividend. Number three, focused tuck-in mergers and acquisitions.
I want to pause on that ranking because it is highly unusual for a massive medtech conglomerate. Historically, companies in this sector survive by constantly acquiring smaller, innovative startups to bolt onto their sales force. Moving M&A down to priority number 3 is a massive paradigm shift. Why the change?
It all comes down to their internal valuation models. When analyst Robbie Marcus pushed them on this shift away from M&A, CEO Tom Holland was incredibly blunt. He stated point blank that management believes the stock is substantially undervalued by the market at current levels.
Oh, wow. They outright said that.
They did. They have run the internal rate of return calculations on acquiring external companies versus simply buying back their own equity, and they determined that investing in themselves provides the highest possible return on capital for shareholders right now.
And they backed up that rhetoric with aggressive action. They didn't just authorize a buyback program for the future, they executed on it immediately. They deployed $2 billion on share repurchases just in this quarter. When you factor in the $300 million they paid out in dividends, they returned a staggering $2.3 billion directly to shareholders in a single 90-day period.
When you zoom out and look at the broader corporate maneuvers, the financial engineering here is just brilliant. A few months ago, they completed the separation of their life sciences business, spinning it out into the joint venture with Waters. They monetized that asset at a highly lucrative 19 times EBITDA multiple.
I see the arbitrage. They sold off a slower growing piece of their legacy business at an absolute premium valuation of 19x EBITDA, collected the cash, and immediately turned around and used that cash to buy back $2 billion of their own stock, which they internally model as trading at a massive, unjustified discount.
Exactly. That is a masterclass in value creation.
It demonstrates supreme confidence in the new BD portfolio and the cash-generating power of those 50 consolidated manufacturing sites.
It really does.
Which forces the final verdict. We've gone incredibly deep today. We've analyzed the 70 basis point productivity offset fighting the tariffs. We've looked at the high margin mechanics of continuous non-invasive blood pressure monitoring and auto injectors. We've dismissed the FDA ship hold as a temporary working capital blip. We've seen the P&L leverage outrunning the Alaris headwinds, the resin hedges neutralizing the oil threat, and the massive $2 billion conviction buyback. Based on the totality of this data, are you calling this a bullish or bearish setup for the retail investor?
It is unequivocally bullish. The justification is rooted entirely in what the management team controls. They cannot control Chinese value-based procurement, they cannot control global oil prices, and they cannot control the historical FDA backlog on the Alaris pumps. But they're executing flawlessly on what is within their grasp.
Right.
The 2,000 Kaizen events are real, the $150 million cost out is real, and the $1.1 billion in free cash flow is real. They aren't hoarding that cash out of macroeconomic fear, and they aren't making reckless, dilutive acquisitions to artificially pump up their top-line revenue. They're shrinking the float, raising the earnings guidance, and expanding margins in a hostile environment.
Give me the actionable summary. If I am an investor holding BDX or I'm looking at it on a watch list, what is the core thesis I need to remember?
The thesis is that BDX has successfully transitioned from a legacy, low-margin supplier of basic hospital commodities into a highly defensive, massive cash flow-generating technology platform. They are aggressively pivoting the portfolio toward high-margin, incredibly sticky technologies that solve the most acute systemic problems in modern healthcare.
The stickiness of the hardware is the real moat here. We talked about the Alaris infusion pumps and the hemisphere monitors being embedded in the hospital's IT infrastructure. But look at their medication management segment, too. The new AI-enabled Pyxis Pro pharmacy cabinets running their proprietary BD Oncada AI software are solving the critical pharmacist and nursing labor shortages.
Absolutely.
When a massive health system installs a multi-million-dollar network of Pyxis cabinets to automate their entire narcotic dispensing protocol, they never rip it out. The switching costs are virtually insurmountable. The hardware footprint guarantees decades of recurring software and consumable revenue.
And that stickiness applies directly to the biologic drug delivery systems we talked about. They are deeply embedded in the supply chains of the largest pharmaceutical companies in the world, providing the critical auto-injectors required for the GLP-1 boom. The new BD is fundamentally leaner, highly focused, and structurally more profitable than it was 5 years ago.
I align completely with that assessment. When you strip away the GAAP accounting noise and the temporary regulatory headlines, the underlying vascular health of this corporate patient is incredibly strong. But before we wrap this deep dive, I want to leave you, the listener, with one final, highly provocative thought to model out on your own.
I know what you're going to say, and it's a great point.
It revolves around a tiny, easily overlooked detail buried deep in the Q&A regarding the GLP-1 weight loss drug market.
The massive pipeline of biosimilar contracts. It completely flips the narrative on patent expirations.
Let's break it down. Right now, the entire financial world is obsessed with the massive profits being generated by the novel GLP-1 drugs from the major pharma titans. BDX is already profiting from this by supplying the pre-filled syringes. But eventually, the patents on those blockbuster drugs will expire. The market refers to this as the patent cliff. When that happens, the market will be instantly flooded with generic versions of the biologic known as biosimilars.
And historically, a patent cliff destroys the profit margins in that specific drug category because the generic manufacturers immediately trigger a race to the bottom price war.
But BDX isn't selling the drug, they're selling the hardware. Tom Poland revealed that BDX has already proactively signed over 80 contracts to supply the hardware for these upcoming GLP-1 biosimilars. Now, put yourself in the shoes of a generic drug manufacturer. You are about to launch a generic weight loss drug into a market with 10 other identical generic drugs. You cannot compete on the chemistry because it is literally identical. How do you convince the patient to choose your version?
You compete on the patient experience. You differentiate your generic drug by offering it in a highly advanced, painless, easy-to-use smart auto-injector pen rather than a terrifying basic syringe.
Exactly. The generic manufacturers are going to be forced into an arms race of premium hardware just to maintain market share. They are not ordering cheap syringes from BDX. They are ordering the most complex, expensive auto-injectors BDX makes. And as we established earlier, the average selling price, the ASP, and the margin on an advanced auto-injector is exponentially higher than a basic syringe.
It creates a fascinating inverse economic model. The pharmaceutical companies will see their margins get crushed by the generic price war, but BDX, acting as the neutral arms dealer providing the premium hardware, will actually see their margins expand.
So model that out. In 3 to 5 years, when the GLP-1 market shatters into dozens of competing biosimilars, BDX could theoretically make vastly more money per dose than they do right now at the absolute peak of the novel drug boom. They are perfectly insulated from the drug pricing wars and perfectly positioned to capitalize on the hardware differentiation. Think about that structural advantage the next time you hear a patient monitor beep. Don't just stare at the immediate spike on the screen. Look deeper at the underlying mechanics driving the pulse. Keep ignoring the surface-level Wall Street noise and keep running your own diagnostics. We will see you on the next deep dive.